Good afternoon, and welcome to the AFS Best Practices Leadership Webinar. Pricing Fundamentals, a review of the first quarter 2023 commercial lending landscape. This webinar will be approximately an hour long, and our speakers today are Don Doherty, Jeremy Charlson, and Rob Lynch. Before we get started, there are just a few reminders for today's event. We do encourage questions. Please use the Q&A feature to ask your questions, and we'll leave some time at the end of our prepared remarks to answer as many questions as possible. We are recording today's session, and tomorrow you will receive a link to listen to the presentation. Thanks for joining us today. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar, Pricing Fundamentals, a review of the first quarter 2023 commercial lending landscape. We here at AFS know how busy all of you are, and as always, we really appreciate you taking the time to join us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out to us with any comments or questions you may have. It is worth noting that the primary source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending. We have been committed to helping banks grow loans and optimize spread and fee levels for over a decade, and have helped numerous banks align market data to their sales and pricing strategies. Our database contains a robust offering of measures and dimensions, allowing banks to tailor their analysis to their own unique footprints and exposures. And it has been independently verified to be regionally representative and statistically significant in identifying risk-return opportunities. We provide our pricing data via dashboards, flat files, and webinars on a regular basis. Our database is also used to prepare the AFS Commercial Loan Pricing Trends monthly newsletter. Please reach out to us if you are interested in receiving our monthly newsletter, or if you are interested in learning more about the AFS Pricing Service. Again, our contact information is at the end of this presentation. On slide 4 is our agenda, which continues to be influenced by our customers and all of you with us today. We all know that these last few weeks have been a volatile time for the banking industry. Deposit outflows, liquidity crisis have been the terms and headlines used recently. But there has also been a renewed focus on what these trends will mean for loan growth and loan rates. We will begin today with a deeper discussion of these market dynamics before diving into the trends in recent C&I and CRE loan growth. Even before the events in March, we were hearing from many banks that they had pivoted away from growing the balance sheet to focusing on optimizing spread and fee levels. Today, we will illustrate just how this new outlook has impacted trends in new and renewed loan pricing. Finally, we will show you one of the ways that we can deliver market data to clients, the AFS Pricing Guidance File, which is a flat file delivery designed as the foundation to build pricing scorecards and audit RM performance. And now, to get us started with the market overview, I'll turn it over to Jeremy Charlson. Jeremy?
Great, thank you, Don. So as Don said, it feels like just prior to March, we were starting to get back to some sense of normal following the pandemic and all of its lingering effects. Unfortunately, March was, to say the least, a very challenging month for much of the industry, particularly for regional banks. In effect, what we saw quite visibly was the negative ramifications of rising interest rates. Banks that catered to wealthy customers faced deposit runs as these customers sought out alternatives in the forms of higher yielding securities money market accounts, and mutual funds. At the same time, inflation and higher interest rates eroded the market value of bank securities portfolios, which had to be sold at a steep discount to meet deposit redemptions. These events have made deposit runoff, liquidity management, and bank funding mixes focal points for the first time in several years. It's worth noting, though, that asset quality and capital adequacy were not the defining features of March's issues, as contrasted with the last couple of downturns and shock events. By many accounts, most banks are well capitalized, well performing outside of a few stress sectors like office, and they're able to lend. And yet what we're hearing from banks is that they're very, very cautious about new lending opportunities, minimizing risk, both credit and interest rate risk, as well as optimizing spread and fee levels, have become the defining strategic priorities for most regional lenders. So what is the net impact here? It means most likely that business lending will contract, or at least slow, for the foreseeable future. Many banks have already dialed back their loan growth expectations for 2023 from low double-digit growth to the mid-single-digit growth. In what follows today, we'll attempt to illustrate how this kind of new market sentiment, if you will, is taking shape across the market. That is, how the loan mix has changed over time, where lending is still robust, and what this all means for recent new and renewed loan pricing. So next slide, please. So as mentioned earlier, deposit runoff is an issue for the first time in many years. And some brief history here is important. Banks were flush with deposits early into the pandemic as the Fed cut interest rates and government stimulus programs injected enormous amounts of liquidity into the economy. So why in March did deposits plummet nearly $1 trillion from a year earlier? Well, the first reason was fears about general bank stability and safety. The failure of Silicon Valley Bank led to broader scrutiny of institutions with similar levels of uninsured deposits and potential losses on bond portfolios. The panic spread through social media, and the ease in which online channels have made withdrawing funds accelerated the liquidity crisis. But there's also the impact of deposit betas, which had been low throughout much of this recent tightening cycle. With money market accounts, mutual funds, and in some cases, even short-term treasury rates offering higher returns, high net worth individuals traded the safety of FDIC insurance deposits for higher yielding accounts outside of the commercial banking system. The good news is that although a number of institutions experienced deposit outflows, they were, according to several market analysts, generally concentrated in the period just following the failures of Signature and SVB, and were most pronounced among a handful of institutions with overlapping businesses and geographies. Still, the recent trend does not provide much assurance that bank lending will rebound or accelerate in 2023. Since deposits are the primary fuel for lending, loan growth for the industry as a whole will likely slow in the upcoming months. Next slide, thank you. So not surprisingly, bank stocks have taken huge hits in recent weeks. Here we plot the KBW Bank Index, which is a benchmark stock index of the banking sector, representing 24 stocks selected from the largest regional and nationwide banking companies. The failure of SVB was the initial catalyst for this drop, but fears of a contagion or broader, previously unforeseen weakness in the system have kept the index well below pre-March levels. There are also still lingering concerns about the macroeconomic environment, meaning whether the Fed rate hikes will eventually take enough of a bite out of consumer spending to induce a recession. Already, some leading indicators, such as the yield curve, the Purchasing Managers Index, and jobless claims, are all pointing to trouble on the horizon. No bank, big or small, will be entirely safe or insulated if the macroeconomic backdrop worsens. From an equity standpoint, this means that banks have even more incentives to be conservative and selective about lending opportunities. In this environment, banks that appear better funded, better hedged against interest rate risk, and those with diversified loan books to manage credit risk are the ones that will perform the best. Without sounding like a broken record, in this economy, banks want to be thoughtful about new relationships and focus on optimizing spread and fee levels wherever possible. Given this backdrop, the fear is that we're entering a credit crunch, assuming this already isn't occurring. We already see evidence of such in the Fed's latest senior loan officer opinion survey. The charts here, they're a little bit confusing, but basically we have measures of supply and demand for C&I credit, with conditions for small firms on the left and large to medium borrowers on the right. The blue line on each chart depicts business loan demand, so a value below zero indicates faltering demand. The orange line is a measure of whether or not banks are tightening lending and underwriting standards. The axis is inverted, so if banks are tightening, the line is also below the zero axis. For all size borrowers, banks have been tightening standards for about a year now. It started when the Fed began raising rates and concerns about credit quality arose. March did little to reverse this trend. In fact, in the first quarter, banks once again tightened standards from already stringent levels. This was no doubt due to the events that unfolded in March, as well as the fact that equity performance in recent weeks has rewarded more conservative banks. Concurrently, demand for credit from businesses is faltering as the outlook for the economy becomes gloomier. By these measures, it's safe to say that we're in a credit crunch. Banks' willingness to extend credit will become more and more restrictive as fewer good lending opportunities present themselves. What strikes me is how much the latest findings differ from just a few quarters ago. At that time, banks were loosening standards to capitalize on the resurgence in business demand that followed from COVID cases dropping. The question is how to reverse this pattern. Even if the Fed cuts rates later this year, the change in bank sentiment from wanting to grow loans to wanting to optimize risk and return may continue to drive trends through at least the end of the year. Now, despite all the chaos in March, broader capital markets have been remarkably calm, as evidenced by the spread between the BAA corporate bond and the Fed funds rate shown here. Essentially, this spread is a measure of risk appetite. The higher the spread, the more investors demand for a given level of risk. You can see, for example, how much it spiked 3 years ago during March 2020 at the onset of the pandemic. It's hard to say why this metric didn't spike during the most recent period of volatility. It could reflect the relatively concentrated effect of the bank failures on the rest of the market, in which most of the stress was felt by banks with overlapping assets and depositor types. There was also the rapid response of the Fed to shore up liquidity, which may have restored general market confidence. We'd like to monitor this indicator as, while not entirely comparable, credit spreads in the bond market often provide some foresight into trends in bank pricing and spreads. This is because corporate borrowers have the option to refinance bank loans in the bond market, so bond spreads can, to some degree, affect the spreads banks can offer on commercial credit. Another question is whether in the bond market or the loan market, the cost of credit will become more expensive. If banks are forced to increase deposit rates to retain customers, then they may choose to pass some of that cost on to borrowers in the form of higher loan spreads, particularly as they become less focused on balance sheet growth and more focused on balance sheet optimization. Later on, we'll take a look at how this dynamic is playing out in the new and renewed pricing trends. So most of us know what happened to deposits in March, but what's been the most recent trend in commercial loan growth? Here we illustrate trends in outstanding balances for C&I loans in the top and CRE loans on the bottom. Trends for the entire industry, all banks that is, are shown on the left, while trends for a subset of the large banks, which represent the top 25 domestic institutions, are on the right. For the whole industry, we saw C&I balances spike in the week of SVB's failure. Our theory is that firms drew down on lines of credit to shore up cash during a period of market disruption. What perhaps is more interesting is the divergence in trends between the large banks and the rest of the industry. Through mid-April, both C&I and CRE balances trended downwards for all banks. The reverse can be seen for the large banks on the right. We know that the large cap banks picked up some market share in deposits during the last few weeks. The same may have been true to a lesser extent for lending relationships. And while large banks, like nearly the rest of the industry, have become more selective about lending opportunities, there is still a willingness to lend to the larger, less risky borrowers, the types of clientele that larger banks cater to more so than the smaller community banks. To that point, we next examine C&I balance growth by ranges of commitment size. And what we see here is a clear bifurcation in loan growth trends between large and small deals. Of the C&I loan growth realized in the first quarter, almost all of it was driven by deals over $25 million in size, with declines seen for the smaller end ranges. This trend is even more pronounced when viewed on a year-over-year basis. This is the same profile we observed both early in the pandemic and early in the months of the recovery from the Great Recession. From a supply side perspective, one way to interpret these trends is that they represent a flight to quality, in which banks gravitate to the larger, better capitalized, higher revenue corporates. We also know that in recent months, small business optimism has waned, which may explain the declines that we're seeing in the lower end of the market. These trends have important ramifications for bank pricing and margins as well. Since larger deals often bear lower spreads and fee levels, a higher influx of large deals relative to small deals can depress all-in rates for banks. Now, one metric we track closely is line of credit utilization, as it helps explain both loan demand and whether borrowers are feeling more stressed than usual. As we mentioned, amid the volatility in March, corporate borrowers tapped lines of credit as a defensive measure. We saw this mostly in the larger end of the market. Notice here that line utilization ticked up for the 5 to 25 and over $25 million segments. Our thought is that the larger corporates, which often respond faster to financial news, drew down on lines of credit to shore up temporary liquidity. In the smaller end of the market, that is to say under $5 million in size, line utilization remains stubbornly low and is yet to recover from the retrenchment that we saw during the pandemic. It's hard to say what accounts for this inverted size profile in the line utilization trends. One explanation is that small business optimism, as we said, is waning. The other, harder to prove theory is that non-banks and fintechs have gained increasing market share in the SME space, and smaller borrowers are utilizing existing bank lines less extensively than they had in the past. When we present loan growth trends to clients, one of the ways that we like to personalize the results is by focusing on their unique geographic footprints. As an example of our service's geographic granularity, here we focused on the 5 largest core-based statistical areas, or CBSAs, in the country, and presented loan growth rates across bank quartiles. Interestingly, while pricing dispersion tends to be more narrow in major metropolitan areas versus rural areas, growth rates tend to vary more in the bigger cities. Take Los Angeles, for instance. While the median bank was down for the month of March, another bank realized double-digit loan growth on an annualized basis. Sometimes smaller entrants or less established banks in these markets post higher growth rates by virtue of their smaller portfolios. Other times, a handful of large banks tend to lead growth in a particular metro. If we use the median bank here as a reference point, Dallas posted the highest month-over-month C&I loan growth in March, while Los Angeles reported the largest drop. Now, from a composition standpoint, we observed some interesting changes in the C&I loan mix over the last few months. By far, the largest concentration at a 2-digit NAICS level is finance and insurance, which is circled red here. This sector is rather opaque. It's mainly comprised of non-bank financial intermediaries, fund managers, and companies backed by private equity. There has been much said about the tech sector recently, how tech companies had to rely on deposits to make payroll and cover expenses. Many of these same debt service constraints apply to finance and insurance companies as well, as these borrowers are very sensitive to rising interest rates. Essentially, these financial companies borrow from banks to increase their dry powder and then invest in other types of risky asset classes. So in this way, lending to the finance and insurance sector creates indirect and potentially risky exposures for commercial banks. We should note that after years of very robust growth in this sector, exposure to finance and insurance borrowers is finally starting to decline. It's a fascinating industry, and it's one that we'll be sure to keep our eye on in the months to follow. In the commercial real estate space, a comparable area of risk is the office property type. The chart here contrasts the non-accrual performance of loans backed by office properties with the CRE average. As the overall CRE market slipped during late 2020 and early 2021, the non-accrual rate for offices remained low as firms, despite having many of their employees working from home, honored their leases. Then in late 2022, as a large number of leases began to mature, firms either renewed for less square footage or abandoned their office spaces altogether, leading to an increase in office properties on non-accrual. Now, many of the banks participating in our service have diversified CRE portfolios. Much like they weathered the storm with lodging through the pandemic, problems in office are unlikely to drag down the whole industry. Still, like finance and insurance in the C&I space, it's an area of emerging risk to monitor closely. Near the end of last year, in bank earnings calls, executives highlighted still strong loan pipelines, which ties directly into recent trends in new and renewed loan volume. Here we look at new and renewed volume over the last couple of years, with the trends for C&I loans up top and the pictures for CRE loans on the bottom. What you might first notice on these charts is the spike in December 2021 in new volume for both C&I and CRE loans. While December is generally a strong month, the uptick in that particular December was extraordinarily large. This was when inflation was really starting to ramp up and borrowers became more anxious about rising credit costs. In all four views, volume ticked up in March of this year, mainly due to higher line utilization in the period. In other words, we're counting new draws under existing lines of credit in this picture. We also provided trend lines in each picture, which serve as a sort of momentum indicator, if you will, for new renewed deal flow. In all cases, the overall trend line is still positive, meaning that there's still some growth momentum left in the industry. How this trend will fare in months to follow will be very interesting. Again, we're hearing from most banks that they've become much more selective about new lending opportunities, which, if true, will depress future new and renewed loan growth. Viewing trends at the new renewed level also helps us visualize emerging risks, or at least changing patterns in the perception of risk. What we presented here is a distribution of new renewed volume by risk grade, in which high pass corresponds to loans with a bond equivalent rating of BBB or better. On first blush, the pictures seem to illustrate risk migration, in which for C&I, high pass volume declined year over year and average volume increased. Similarly, for CRE, average volume fell and low pass volume increased. What I think is happening here is that rather than banks chasing riskier deals or risk migration taking place, I believe what's happening is that banks are becoming more conservative in how they risk rate credit. So, for example, a loan that in last year's economic environment may have been rated high pass is now, in a more uncertain market, risk rated much worse. So now we transition into a look at commercial loan pricing trends. Here with a distribution of the pricing mix in terms of new and renewed deal flow. SOFR has clearly emerged as the dominant pricing index for both C&I and CRE loans, comprising more than half of the total dollar-denominated new and renewed deal flow in March. As of this month, we see just a handful of banks utilizing BSBY and other floating rate alternatives. Note that BSBY has an advantage over SOFR in that it's inherently credit sensitive and doesn't require a credit adjustment spread, which we've heard anecdotally can be an area of contention or at least confusion in pricing negotiations with borrowers. Of note is that fixed lending as a percentage of total new and renewed volume declined year over year for both C&I and CRE loans. When you think back to the banks that failed in March and April, they had asset liability mismatches exposed by the Fed's rate hikes. Thus, we expect there to be greater investor and regulatory scrutiny of fixed rate lending, particularly fixed loans with long durations. So for a closer look at bank pricing trends and how a more conservative sentiment among banks is impacting spread and fees, I now turn the presentation over to Rob Lynch.
Thank you, Jeremy. Hello, everyone. Let's start by looking at new and renewed interest rates over the last couple of years. In these charts, we're going to show Fed funds rate depicted by the gray bars, along with the average interest rates for new and renewed loans depicted by the blue and orange lines respectively. The C&I trend shown in the left-hand chart shows that for the last several months, new loan pricing exceeds renewed loan pricing. And with credit standards tightening, pricing also increased. And banks are becoming more selective about new relationships. In the right-hand chart, we see that renewed CRE loans have been priced above new loans for the past 2 years. But the gap between the new and renewed is widening, reflecting the bank's aggressiveness in going after yield. On the next slide, we present a trend of SOFR and prime spreads over the last 5 quarters. Spreads on SOFR-based C&I loans in the top left-hand chart have shown very little movement over the last year, despite all the interest rate hikes from the Federal Reserve. Spreads on SOFR-based CRE loans in the top right-hand chart decreased slightly from 4Q and are slightly above the year-ago level. Spreads on prime-based C&I loans shown in the lower left-hand chart rose significantly in the last quarter after being in a tight range throughout 2022. And spreads on prime-based CRE loans in the lower right-hand chart also increased in 4Q, returning to the same level from a year ago. On the next slide, we look at fixed-rate loans. Here in the left-hand chart, we see that interest rates on fixed C&I loans in March increased the most for loans with a short duration. This drastic increase is attributable to the Federal Reserve beginning the process of raising interest rates a year ago. It's also interesting that with the exception of the 1 to 5 years duration, these rates are in a tight range. In the right-hand chart, we show CRE fixed rate loans, and we see a similar trend, namely that interest rates rose the most over the past year for the shorter term durations. On the next slide, we show pricing across the country. And you can view this slide as a heat map to see where interest rates are in the various states. And as you can see, a majority of states are now recording average interest rates at 6.5% or higher. There are only a handful of states reporting average interest rates below the 6% mark. And on a quarter-over-quarter basis, in most states, interest rates rose considerably, reflecting the Fed rate hikes, and in most cases, about 100 basis points or more. On the next chart, we show the SOFR equivalent spread distributed by risk rating. The SOFR equivalent spread is a measure that allows us to group and compare floating rate and fixed rate loans to determine the overall spread contribution of these loans. For both C&I loans in the left-hand chart and CRE loans in the right-hand chart, it's clear that the investment grade risk bucket is priced considerably less than the higher risk grades. It's also interesting to note that the pass investment grade for both C&I and CRE loans were in a tight range over the quarter. On the next slide, we highlight the SOFR equivalent spread throughout the quarter for industry sectors. I want to point out 2 industries in the middle of the chart, namely information and transportation. Spreads in the information sector increased dramatically in February and held that level through March. And contrast that with transportation, which came down a little bit in February, but dropped dramatically in March. This drop was attributed to large deals that were very aggressively priced. On the next slide, we'll take a deeper dive into CRE-based loans and look at different property types. This chart shows us that healthcare and office property types had the highest increases in spread over the quarter. And with the recent stress these industries experienced in recent months, it's not surprising to see them showing an increase in spreads. Other commercial real estate, buildings, and retail showed the largest declines in spread over the quarter, which might be somewhat surprising for those sectors. Turning next to fees, these charts show a trend of upfront fee incidence depicted by the blue line and upfront fee level depicted by the orange line for both C&I and CRE loans. For C&I loans in the left-hand chart, upfront fee incidence rose slightly over the quarter, while fee level continued its progression lower. For CRE loans in the right-hand chart, fee incidence declined to the lowest level in the last year, while fee level varied greatly over the quarter. Also note that CRE upfront fee levels are notably higher than those shown for C&I loans. And while upfront fee incidence for both C&I and CRE are currently below 25%. The next chart provides a deeper look at upfront fee level by segmenting the data for the quarter by commitment size. On this slide, the left-hand chart shows the upfront fee level for C&I loans, and the right-hand chart shows upfront fee level for CRE loans. On both charts, we plot the average, shown by the blue dot, and the range in each deal size category represented by the lines. Notice that in the less than $1 million range, both C&I and CRE loans have the same average upfront fee level at 36.5. From there, upfront fee level for C&I loans shows a lower average and very tight range as deal size increases. For CRE loans, upfront fee level for loans greater than $1 million goes higher, and the range can be quite wide in these categories. The tight ranges in the larger C&I loans could indicate more competition for these types of loans, which are usually the better credits, whereas on the CRE loans, banks do not appear willing to waive many fees and are charging fees to account for a potential increase in risk. Now I'll turn it back to Jeremy, who will show you an example of how we deliver data to clients via the AFS pricing guidance file. Jeremy?
Thank you, Rob. So we just want to take a moment to show you an example, as Rob said, of how we deliver data and information directly to clients participating in our pricing service. What you see pictured here is a flat file delivery that we call the AFS pricing guidance file, which lists all of the new renewed transactions for the bank down the rows and the indicative characteristics and measure of pricing across the columns. So you can quickly filter for all the loans in a particular line of business or industry. What's really special about this file is that for each bank loan, we append a market equivalent rate, spread, and fee level based on market loans that share the same industry, geographic location, and so on of the bank deal in question. It's not made up or smooth data, but rather the real facts on pricing in today's marketplace. You can then array the loans by their difference from the market observations that quantify areas of strength and opportunity. That's what we have pictured here with the bar graph. The observations here are normally distributed, but we do see loans with real bank data where the bank's pricing is more than 100 basis points off the market average. You could then, using this file, see whether the outliers are concentrated in a particular segment and address them accordingly. The file is fully customizable. We can present statistics at both an obligation or a segment level. The file format is also easily consumed into a data mart or data lake for additional analytics at your bank. And so before we sign off, we just wanted to summarize once again the state of the market. Even before the most recent crisis, banks were tightening underwriting standards on commercial loans, and the events in March and April have certainly intensified that trend. Loan growth forecasts have been revised downward, and we're not seeing much growth outside of the larger end of the market. We continue to monitor pockets of stress in the commercial lending space, such as the finance and insurance sector and CRE loans backed by office properties. Banks will likely have to raise deposit rates, though as of the first quarter, we haven't seen a ton of evidence that they've passed on higher credit costs to borrowers in the form of higher loan spreads or fees. And finally, we encourage banks to be mindful of fixed rate lending. Like the yield curve, fixed loan yields are currently inversely correlated with term length, and banks should be very careful about going long on these asset types. So as always, we thank you very much for your time today, and especially for the banks that participate in our service. So Renee, I think take a moment to see if any questions have come through the line.
Yep, thank you, Jeremy. Excuse me. Yes, so please use the Q&A functionality for asking us questions. We do have a question, Jeremy. It's on slide 12, which Lisa is getting back to. On slide 12, with C&I utilization rates, what explains the marked increase in utilization rates on very large revolvers, green and yellow lines, versus the more muted increase in utilizations on smaller revolvers, black and orange lines? These developments precede the SVB event. The increases seem to start in late 2021, so it's unclear how they may be related to the tightening cycle. Your thoughts would be appreciated.
Yeah, so a couple of comments related to that particular chart. So the first is that line utilization had been on the rise in kind of late 2021 through maybe mid 2022, right? That's when inflation started to rise and borrowers responded by drawing down on lines of credit before credit costs increased too substantially. So that's one part of the trend. We saw that happen a lot faster for the larger borrowers. Small business optimism really was a lot slower to recover. So it was the bigger borrowers that kind of anticipated higher credit costs and began drawing down on lines of credit. There was too, and what I was speaking to, I think specifically on this slide, if you just focus on the month of March of 2023, you can see there is a tick up in line utilization. And that did correspond with the SVB events and the other events in March, where we think some of the larger borrowers tapped lines of credit, again, as a defensive measure. It wasn't nearly to the same extent that we saw during the pandemic, but that spike was one of the larger month-over-month increases that we've seen in some time. So again, there's kind of two parts to that trend. There was line utilization increasing in 2022 due to inflation, and then more recently, another kind of modest spike, but still a significant spike or a meaningful spike in the month of March that corresponded to kind of the turmoil that we saw in that particular month.
Thanks, Jeremy. And the person that asked the question said, thank you for the insightful response.
Thank you for attending. We really appreciate your question.
So that looks like our questions for today. We do appreciate everyone attending. And as a reminder, we will be sending out an email with a link so that you can listen to the presentation and share with a colleague. Thanks again and have a good day.
Thank you, Renee.